So I'm going to buy new construction, and the day that it closes, I'm going to sell it. Don't do it. Everybody, it's Hussein Kabani, your favorite broker. And this is a question I get a lot, so I want to address it. And so I can send this video to you if you're asking me this question. What people want to do is they want to buy new construction, and as soon as it closes, they have a plan of selling it because they're going to make all this money on it. What I do want to point out to you guys is that builder price is actually a little bit different than what you think, okay? So the builder price that's typically advertised, that actually already includes about a $24,000 HST rebate that comes directly back to the builder if you're going to be occupying the home personally. So if you're personally going to occupy the home, you don't have to worry about this. So this rebate, it's not added to your purchase price, and it comes directly to the builder once you guys close. Now, if you go to the builder and you tell them, yes, I'm purchasing this property for an investment. So either I'm going to be selling it once it's built, or I'm going to be renting it out once it's built. What they will do is they will pretty much add that $24,000 to your bill when you go to close, okay? Because you're not entitled to that HST rebate because you're not going to personally occupy the home. So you're going to have to pay this up front. Don't forget that. Now, of course, there are people out there that go on and say, hey, this is going to be my personal residence. I'm going to close on this and, I'm not going to pay the tax. Well, if you go and flip that property and CRA finds out for it, in my experience, they're not going to ask you any questions. They're just going to send you a tax bill, and it's going to be up to you to tell them why you don't owe it to them, okay? Typically, if you're going to do something like that, you probably want to stay in a house for at least a year. That's the most I want to venture into that area over there. But look, if you're going to buy a property for an investment, you're going to have to tell the builder that up front, and when you do, you're going to pay the HST. That's the bottom line. Now, if you're going to flip that property, that HST, you might as well just bake it into your cost of doing business, okay? That's just going to be a fee like paying a realtor fee or a lawyer fee or whatever. That money is going to be gone, okay? That's HST. Now, if you're going to be an investor and you're going to lease that unit out or rent that unit out, then you actually have a shot at getting all, if not all, most of your money back, your HST money back, even though you've paid it up front, okay? So the way that it works is that you're going to get possession of the house, you're going to lease it out. And what you're going to do is you're going to provide the government a standard form that they have for the HST rebate and a copy of the lease. Now, I don't really suggest that you fill this form out yourself unless you like putting yourself through pain. But there's a lot of companies out there that specialize in HST home rebates, new home rebates for you. And they pretty much take about $200 to $300 to fill it out for you. I'd go that route if I were you. And most of the time they're able to fill it out in a way that you get all your money back. If not, I think like up to 95% of your money back. But you got to lease out that property for 1 year to get that credit. Now, that we're beyond all of this closing and whatnot, guess what? You have that rental income still coming into you, okay? So if you're going to rent out your property, you have that rental income coming into you. You got to be careful with this because what's going to end up happening is that you're going to be able to use some of the expenses that you're going to face to write off that income, okay? So now, basically what you're going to be able to write off, you're going to be able to write off your property taxes, you're going to be able to write off maintenance. If you have a condo fee, you're going to be able to write that off. And you're going to be able to write off the interest of the mortgage, not the principal, so not your full payment. That principal money is actually going into a piggy bank for you, okay? So these are the expenses you're going to be able to write off. Now, I'm just roughing it here right now, guys, but if your rent is $2,000 and your expenses in total $1,000, let's just call it, okay? Then you have $1,000 basically of income that's coming into you. So you times that by 12, you have $12,000 of income. Now what happens is that, say for example, you make $60,000 a year at your job. You're gonna get taxed at a certain tax bracket for your $60,000. But guess what? This year you had a rental property. So now what it's gonna be is $60,000 plus your $12,000 in profit from the rental. So now you're gonna get taxed at an income of $72,000. So you gotta be careful. Your income bracket is gonna go up and you're gonna be taxed on all of that money, okay? So you gotta do your math, talk to your accountant and make sure that it makes sense for you, and if they have suggestions on how you can actually play around with that situation. I'm sure there's a couple of different things you can do over there. And the other thing, just to backtrack a little bit, because we're talking about taxes now too, is that when you do go and sell that property at some point, or if you sell it right off the bat, remember, there's not just HST, there's capital gain tax as well, okay? And the way that capital gain tax, in a quick summary, works in this way. say you purchased a property for $650,000 and you sold it for $750,000. We're just going to talk quick and simple math. You made $100,000 on this property. Now, what's going to end up happening is that you're going to be subject to 50% of that earnings as capital gain tax, okay? So basically you made $100,000, $50,000 of it will not get touched, but that other $50,000 gets added to your personal income. So now again, if you make $60,000 and now this year you sold a property and now you have a capital gain of, taxable of $50,000, well, that gets added to your 60 that you made. So now your income goes to 110. And believe me, that's a significantly different tax bracket from being $60,000 than to being in $110,000. So you got to be careful with what you're doing. You got to use a good accountant to make sure you guys know your numbers as well. So that's, in a nutshell, is about new construction purchases, how the taxes work, and how a rental income works with that. If you guys have any questions about it, I'd be more than happy to answer them. Like this video, leave me a comment, let me know what you think, share it with your friends. Until next time, remember one thing, guys. Get Cabani, get sold.
Sell it, sell it, sell it, sell it, sell it, sold. Sell it, sell it, sell it, sell it, sold. Sell it, sell it, sell it, sell it, sell it, sold. Sell it, sell it, sell it, sell it, sold.